Okay, hi Ramneek. Very happy to have you here, and it's very, very nice to get to speak with you. How are you today, first of all?
Very well, Michelle. Appreciate the opportunity and good to be here.
First of all, congratulations again for the closing of your last fund. Do you want to talk about it a little bit, and you want to introduce PruVen Capital to everyone that is listening?
Yes, first of all, thank you so much for that. It has been a hard fought effort, and we are very fortunate and thankful for the milestone we've reached. A little bit of background on Proven Capital. I started this firm about 4 years back at this point in August of 2020 on a model that I call independent yet integrated. What that means is we are, on one hand, very deeply integrated into the businesses and functions of our limited partners or investors in our funds, who happen to be some of the largest and leading incumbents in the insurance and asset management ecosystem. In Fund 1, we had one partner like this, which is Prudential Financial. In Fund 2, in addition to Prudential Financial, which is our key partner and anchor, we also have nine others that have come together. And the goal with the extension of our partner or LP base in Fund 2 was to be able to capture and cover the entire value chain in the insurance and asset management ecosystem. So in our case now, we have in the insurance world both life and P&C carriers. We have international and US carriers, international being the largest in Japan and the largest in Europe. We have distribution as well as manufacturing. And then we also have the entire asset management ecosystem represented. So the groups that have come together in our Fund 2 include Prudential Financial as the anchor, but on the US carrier side, in addition to them, it's TIAA. It's Lincoln Financial, it's Mutual of Omaha. On the international side, it's Nippon Life, the largest in Japan, Generali, one of the largest in Europe. On the distribution side, it's Willis Towers Watson. And on the asset management side, it's Nuveen, it's PGIM, it is Generali Asset Management, as well as Nisei Global. So collectively about $4.7 trillion in AUM among these four. So what we've tried to do is, as I mentioned, cover the entire ecosystem with our LP base. And our model is to very deeply integrate into the business and functions of these partners of ours, Michelle. Through that deep integration, we get a deep understanding of where they're headed, what their needs are, what their roadmaps are, what gaps are emerging. Utilize that as an insight to identify the very best companies in the startup ecosystem, and in a very curated way, bring those back to our partners to drive towards commercial outcomes. And we also integrate into their control functions, into procurement, into their legal function, etc., to help not just with introductions, but actual POCs, pilots, and ultimately commercial outcomes. And that's where we distinguish ourselves in the venture ecosystem. We promise, not promise, but there is a promise of enabling commercial outcomes that are mutually valuable for our startup founders as well as our LPs who are large incumbents, as I mentioned, when we get involved in these companies. And that mutual value creation also leads to a lot of, equity value creation. So that's sort of the integrated part of our model, very deeply engaged with some of the largest incumbents in insurance and financial services ecosystems. But at the same time, structurally, Michelle, we are set up to be completely independent of all of our large incumbent partners. So we are an independent firm and fund, which is owned 100% by the team here, and all of our partners are LPs or investors in the fund, but that's where the line is, and that allows us to move quickly, make decisions independently, and most importantly, not be shall we say sometimes impeded by the control functions, compliance, and bank reg, insurance reg, these sort of situations when you are captive to one of these large global organizations. So we've
Yeah.
tried to create the best of both worlds. On one hand, we have the deep integration that allows us to create the value, but on the other hand, structurally, we are completely independent, which allows us to improve upon some of the constraints that come from being deeply integrated with these large incumbents. Now, that, in a nutshell is PruVen Capital. Our fund one was raised 4 years back, as I mentioned, with at $300 million. We are designed to be multi-stage. So we invest in Series A through growth equity. Check sizes range from 5 to 30 million usually. And we tend to focus on a host of verticals and horizontals. Our key focus is on what we call enterprise enabling technologies. What that means is any B2B software that large enterprises like our incumbent partners who are LPs can leverage and utilize in the operation of their businesses and functions. So on one side, it is the technology related ones. So enterprise IT, so data analytics, machine learning, AI, DevOps, info security, automation, etc. On the other hand, that could be any functional B2B software. So it could be Office of the Finance, Office of Procurement, HR, marketing tech stack, etc. Or it could be something that supports the businesses. So if it's an insurance, maybe claims handling and automation. Maybe it is about fraud and payments and payment facilitation in case of money movement, etc. So we focus on this broad horizontal that we call enterprise and enabling technologies, and also are well situated to focus on the verticals themselves, being financial services, insurance, real estate, prop tech, and digital healthcare. So that's in a nutshell who PruVen Capital is. And we're, like I said, very fortunate. Fund 1 is 300 million, and we recently announced Fund 2, which closed at 378 million from all of these leading partners as LPs.
No, that's really interesting and also really clear. So basically, you are taking advantage of the kind of LP that you have right now on your side in order to give the founders of those startups basically a commercial and distribution advantage on the market. So they are able to reach, the final user, if you're B2C, of course. Thank you to those LP that provide those kind of competencies and those kind of skills on top of the retail knowledge and the retail, let's say, chain of value there.
That is 100% on the dot. I could not have said it better, Michelle. That is exactly our value proposition. And the inspiration and insight for this came from almost 14 years of work on this particular area from my side. So prior to this, I was the co-founder and co-lead of Citigroup's venture investing efforts globally. And during that period of 10 years that I started and built Citi Ventures, I figured out, or as a team, we figured out how to create this mutual value, how to create, leverage the depth domain distribution of a large incumbent to, create distribution and revenue and the first revenue customer kind of relationship with our startups and vice versa. And that took a long time. That took a lot of effort, but we figured out over the course of 10 years, 140 companies that we as a team invested in, 3/4 did a POC pilot or commercial deal with Citi, and nearly 70, had commercial relationships with Citigroup and businesses and functions as a result of our efforts. So we were able to do this at scale. We were able to do this predictably and systematically. And that's the playbook that we created. And at the same time, the financial returns were tremendous. I personally led 24 investments over the course of 10 years, of which 10 became iconic. So companies like Square, DocuSign, Jet, Plaid, Honey, Grab, Feedzai, DataRobot, Zoom, etc. So I think once I had the proof points that we can create both strategic value, as evidenced by 70 plus situations where our portfolio did commercial deals, as well as financial value, as evidenced by our early investments and tremendous equity returns, I said this is really possible. And then I set out to improve upon the structure. At Citi Ventures, we were obviously captive, and that created some challenges in terms of upside sharing, in terms of it was not a fund structure, in terms of constraints around control functions, etc., which is what we improved with the PruVen Capital independent yet integrated model.
No, that's pretty interesting. I think that you kind of found your secret sauce on those kind of things. Leveraging the distribution, leveraging the commercial channel. I wanted to come back to the portfolio later on, but first of all, the first question that I wanted to ask you was: okay, you raised your first fund 4 years ago. Now you raise a new fund. How hard it was to raise those funds right now? Because we all know that the environment changed a lot during the last 4 years. 4 years ago was a different, age in this kind of market, and right now everything is harder. So how hard it was right now?
I will not sugarcoat it, Michelle. It was very,
Of
very,
course.
very hard. It took us almost 2 years of very, very focused effort to do so. And part of it was the environment for sure. It was not, part of it was also what we were trying to do, which is so unique. And so let me explain the second part. We think that when we started PruVen Capital, we were very clear that this is an activity that tends to get better within limits as the number of nodes increase in the network, right? So we started with one node in our LP base, which is Prudential Financial, one of the best and leading incumbents in the insurance ecosystem. But we wanted to, with Fund 2, increase that carefully. But there is also, with every network, there is also a limit on, after some time, every additional node does not lead to additional value creation for the network. In fact, it dampens the network, right? So we wanted to figure out what that efficient frontier was, because of our unique model of very deeply integrating with the businesses and functions of our large incumbent partners. You can imagine how big these businesses are, how global
Yeah.
they are, how varied they are,
And
and
wide
doing
their
so.
network is.
Exactly. So it took us even 4+ years to even get to a place where we can operate quite effectively with Prudential alone. And now we were taking on 7, 8 other partners. So we had to think about this very, very carefully. And we said, look, we do not know what the efficient frontier is, but we said it makes a lot of sense to have 8 to 9 additional partners. But then we said if there are only 8 to 9 additional slots, we want to be very, very, very careful and surgical about who we want in these slots. And that made our process a little bit harder, Michelle, because multiple of the same kind do not add to the diversity and therefore value of the network. We wanted to cover the entire value chain and in the ecosystem around insurance and asset management, as I mentioned. So we have made it a little bit harder for ourselves, I will say, because once you get some partners of a kind, others of the same kind really want to get on board as well.
Yeah, of
But for us,
course.
that was not valuable. For us, now we wanted somebody else. So that's why, as I mentioned at the very beginning, we tried to have groups that were on the life and PNC and commercial side. We tried to have groups that were international, two key markets like Europe and Japan, some of the largest after US in terms of insurance, as well as US represented. We wanted to have representation from distribution. So we wanted to, and one of the big three, basically Willis, Towers, Watson, or Aon, or Marsh. And obviously, we had all the manufacturing carriers on our partnership base. And then we wanted asset management in all its glory, which is where we were able to succeed ultimately with Nuveen, PGIM, etc. So the idea is that we wanted a very specific set of partners, and that made the whole exercise much, much harder. But at the same time, we also had something unique. We also had real proof points on why this model works, both because of my track record and my team's track record historically at Citi. I grew up at a top tier venture firm on Sandal Road called Battery Ventures. So all of those things in my track record in being able to create both traditional financial returns as well as strategic returns helped. Our progress that we made with Fund 1 and some of the exits we've had on that demonstrated the power of this model was also helpful along the way. And the Prudential leadership, which has been our close partners, they helped and went above and beyond and got us connected to the right places at some of their ecosystem partners, etc. So all of that came together. While it was very hard because of the market condition as well as the uniqueness of what we were trying to do, we also had some things that were working for us. So fortunately, we were able to get it done. But I will end by saying it was very hard. I have gone
Yeah, no.
much more gray than I used to be. Let's just put it that way.
I think it's a common, something very very common recently in this market, but yeah, I get to understand it. But overall, I think that this is a trend that I saw recently, very very common in the market. So everyone wants to have investors that are able to bring some kind of value, real value into the company. I mean, 5-6 years ago, every investors was a good investor. They just needed money, and it was easier to get capital and everything else. Right now, an investor need to bring something on the table that is either be, skills, commercial value, or potentially being also a customer on top of being an investor. So I think that you find a very good spot there. I understand that it makes things harder, but at the same time, I can see the value of actually having something like that. But coming back to the portfolio that you were describing, I was looking at it right before the call, and I think that I saw a couple of companies that I really like. Like for example, I would love to hear your investment on Square, to be honest, because it was one of the companies that I like the most in the fintech space. And coming from that environment, I must know and ask about it, because I think it was a huge investment and a huge deal, and you were a real visionary to invest on something like that in that year.
Thank you for saying that. It is one of the big successes in my journeys thus far, at least on the venture side. And let me give you a little bit of how that happened. First part was, how did we, maybe I can describe it in the classic framework of source, select, and support. How did we find, how did we select and convince the teams to partner with us, and then what did we do after? Maybe I can do it in those three phases. So on the sourcing side, we've been investing in fintech before that was even a word, and so have had the chance to think through and look at a lot of various efforts and opportunities emerging in the fintech 1.0, 2.0, whatever versions you can call, various waves that have happened. And my learning has been, not every day a new Citigroup or a new Deutsche Bank or a new JPMC gets created. Because it's not just about technology. It's not just about product. A lot of things have to come together. Cost of capital and your access to capital is a very, very big thing that one has to solve for. And that keeps changing as you grow in these businesses, because capital is your raw material. Giving out capital is easy. Getting it back after 1, 2, 10, 15
not that easy.
is the hardest, right? So that is something that the venture ecosystem and generally the startup ecosystem are emphasized in terms of how valuable it is, right? Similarly, underwriting, having the right information and data and on-us information of having interacted with these customers over a period of time to make a reasonable prediction on whether they are good or bad customers, and that was very hard to do for most people. If you don't have unique data sources, that is very hard to do. Collections. When you think about giving out money, you have to bring it back at some time. That is so there are so many things. Regulatory. This is, we are talking about money, not about...
Compliance is by far one of the main barriers in this market. And we saw that in Europe recently, with,
You said it. And so it was very clear for us, having seen how hard it is to build, scale, operate these businesses within the various functions and units within Citi. It was clear to me that it was not just a tech play. Right. And so when we came across Square, a few different things came together for us. And all of these things that I laid out seem to be true there, whereas it was never true in any of the other situations that we met with. Right. What was the case that attracted us in Square's situation? When I talked to them in 2011, the whole conversation we had about with Jack Dorsey was about how someday, and it wasn't clear at that point when that someday would be, but we would be creating a lot of value through what they ultimately called Square Capital, which is the lending business. And I could see that if they built out what they were building to scale, they would be the absolute winner on SMB lending. Why? Because they already had the customer acquired for a very critical service, which is payment processing. So no additional customer acquisition cost. They had very unique information and data. They had the lifeblood of these businesses. They were processing transactions. They knew exactly how these businesses doing by the second. who has that information? If you go to a bank, you provide them, last quarter and audited statements at best, and not even at the granular level of per transaction, etc., right? And not even in real time. So they had the best data to underwrite these SMBs with. So the hardest things in SMB lending, acquiring those customers, underwriting those customers, they had above and beyond anybody. The third part, collections. They were through they were the one that were collecting the revenue for the customer, and they would take a part of it. So collections were just built into the system. No
It was
additional.
automatic,
Yes,
basically.
exactly. And above and beyond all of this, they had built out what was not clear at that point about Square, and which is why you saw every competitor jump in with their own innovation. Oh, Square has a dongle which is square. We will have a triangle. We will have this, that, and the other. And everyone thought that was enough. But what people didn't understand is the real innovation there was, why would they be able to build the biggest network for payment processing and acquiring, is because they were able to underwrite these merchants in and onboard them in under 5 minutes. That nobody had solved. If you, after First Data or PayPal launched their equivalent business and Verifone had their own business, etc., it still took 2 to 3 months to go through their underwriting process. Whereas Square had a very, very powerful, progressive risk management system that allowed them to onboard these merchants very, very rapidly. So we knew they had an iconic product. They had a celebrity CEO who's that helped with a lot of zero CAC. In fact, they spent no money in the early several years in terms of merchant acquisition, and they had better underwriting. Orders of magnitude better underwriting and onboarding process than anybody else out there. So I had the conviction that they would build a very large SMB merchant ecosystem, and then on top of that, Square Capital and all these additional products would be very natural for them to launch, because they also have all of these other assets that are getting built because they're building the base network. So that was the deep insight when we invested in 2011, that first and foremost, they will build out this network, and they're best at doing so. And then they will continuously enhance the outcome, or the marginal revenue and marginal gross margin, by adding all these additional products on top of this, because they're the best position. And so our thesis when we invested was not even about their core product, which is payment processing. It was about Square Capital and some of these additional products that launched 4 years later, Michelle. So that is the sourcing part. We were able to build this thesis, go to them, and there was a lot of resonance. Like I said, the meeting that we had with, at that point, it was Jack Dorsey and Keith Rabois, who is the CEO. The entire conversation was around our belief that they could be the best SMB lending solution, and they themselves saw it, but they never talked about it because it was still 4 or 5 years away. And that's
Because it's
how
not
we
present at
built.
the moment. So
It was not present at the moment, not even in the next quarter or next year. It was 4 years away. So in 2011 timeframe when we invested, it was primarily that thesis and that conviction and that understanding that these guys were positioned to be the leader for these reasons that I laid out. That's what led to the investment. Second, they didn't need our capital. They did not need anybody's capital. They were everybody wanted to invest in them for one reason or another, and that's where the ability to bring Citi to the table. We shared and we talked about how when they launched Square Capital, they don't want to build out the balance sheet. That's something that Citi as a bank could be a partner to them on and help them scale Square Capital down the line. And that was the reason why, among other things, that they decided to partner with us. So that was sort of the reason to drive the investment, and that's the sourcing part. How did we select a source and select this company, and why did we partner with them? Now let's come to the supporting part. After we invested, how did we help out, right? That is a critical part. So this is a lesser known story, Michelle, but one of the things that we learned about after we invested is what is called the Community Reinvestment Act, the CRA, it is called in the US, where every large bank which has a balance sheet and asset base above a certain amount has to invest a percentage of that balance sheet in the communities in which they have operations and they have banking branches, etc., etc. The idea is they have to reinvest it back
In the
towards
community,
low-income
of course.
housing for
Yeah.
teachers, firemen, etc., etc. They have to invest it back into small, medium business loans because that's what drives the economy, etc., etc. So this is something that is a requirement, regulatory requirement. It's a CRA obligation that all of the large banks have to drive their CRA obligations, which are determined by the size of their asset base or their business. That dollar amount that has to go back into their communities. Now, the challenge that we started to see and hear about at Citi is that Citi, as you know, after the 2008 global financial crisis, ended up going a different direction than the other big banks. Citi started to shrink
Yeah.
its physical branch footprint in the US. So
Was one of
Citi
the first one to do that, if I
to
remember
do that.
correctly. Yeah.
Exactly. You very correct. Very correct. So JPMC and Bank of America today have 8,000 branches in the US. Citi has less than 700. At least when I left and last I checked it about 2-3 years back, right? But on a balance sheet and asset basis, they are about the same scale and size as some of the other big banks, right? So their CRA commitments and obligations are about the same size, but they have to be driven through a tenth or smaller footprint relative to the other banks. So it was becoming a challenge for cities as we were. This is the power of being connected to a large incumbent. You start to hear about some of the key challenges that are emerging, and this was one of the challenges they were thinking about how to solve, which is to drive their CRA obligations through a smaller and shrinking branch footprint. And that's where we were able to connect the dots and say, hey, what about for SMB lending? What if we partnered with Square, that is trying to build Square Capital, and we buy or invest in those loans, and our CRA commitment will fund the balance sheet of the Square Capital loans, and we get the credit because we are funding SMBs in our ecosystem. And but it was not the loans originated outside of your branches at that point were not allowed to were not CRA eligible. So we had to work over 2 years. We had to set up a pilot program. We worked with the regulators, with the relevant groups at Citi and Square Capital to figure out how to do this and make it CRA eligible. And this was the way we added value, where we were able to bring CRA capital and commitments are much lower cost, so they reduce the cost of capital for the SMB customers that Square had. The Square benefited because it could access a big balance sheet at a lower cost, and Citi benefited because it was able to fulfill its CRA obligations, which are considered to be very important.
Those kind of loans are part of the ESG ratio that also banks need to have right now at the moment in terms of
that can
investment.
later on that also became part of the
So
determinations.
you were anticipating the times in many different way.
That's right. That's right, Michelle. And this is
Yeah.
where I wouldn't say we anticipated all of this. We discovered these things later on. So after our investment, I think we came across the CRA thing around 2012, 2013 after our investment. And that is the being the few groups that has access to the external world and the internal world and is able to make those connections appropriately. That's where the value gets created, which is why I focus so hard to be at this intersection and create this intersection between large incumbents and the startup ecosystem. And PruVen sits at that intersection because I saw how powerful this was. Nobody would have imagined within Citi that they could solve for this CRA thing this way. Nobody within Square would have imagined that they could access the CRA obligations and capital of large banks in the US. But we were able to figure that out. And
They couldn't do that on their own. They
on
needed
their own.
someone in the middle to put everything
Exactly,
together,
exactly.
basically. Yeah,
And that is the
that's
power
really
we
interesting.
bring and our model brings,
Yeah.
Michelle. Hopefully, that gives you a good sense of how we got to Square, why we built the conviction, and how we built the conviction that they would be a leader in this space. And then ultimately, after our investment, how we help them on a critical solution, which is our model. If we are not able to add that value, we are just another source of capital, and there is way too much competition at that level. But at the level of being able to add value through commercial deals, very few people operate at that level, and that's why we stand out.
No, that's really really interesting because I think that is one of those propositions that is very rare in the market right now. You know, as you said, mostly a couple of years ago, capital was very common, and you know it was basically free out there to get money. So it was easy to provide just capital, but providing also commercial values, it was way harder. You know,
And one thing
let me
I'll
let me.
add to that, Michelle, very quickly is I, as you said, a few years back, this has always been important. As they say, if
Yeah.
you are familiar with the adage that first-time founder worries mostly about technology and product, a repeat founder always and always worries about go-to-market and distribution.
Yes,
And
distribution most
that
of
is
all.
the hardest thing to do,
Yeah.
especially when it comes to financial services and all these places where a cost of customer acquisition can be in the thousands, right?
Yeah.
I have always tried to solve for that. I think that is one key challenge which is evergreen for all startup founders, and very few of their partners can actually help them, and we are designed to do that. And there is this question that we asked ourselves, why now? And we believe there is a very important time element to this as well, which is about 3 4 years back, as you said, when capital was nearly free, there were different ways people could brute force growth, right? Now, one
Yeah.
way was they could spend $3 to generate $1 in ARR, right? It's
And
inefficient, but
that's
they could
easy.
do that, right? The
Yeah,
other way to do
absolutely.
it, and a lot of people did that. The other way to show growth was sell to other startups. All startups were flush with capital, so you could sell to
Yeah.
each other and people are all buying. Now that free capital has gone away, in today's environment, these ways of, let's just say, demonstrating early growth have sort of disappeared. So the only real way to build a real business today is to sell to businesses and large enterprises who are long standing and like our enterprise partners, and build your you get the first one like a Citi, then JPMC becomes easier, etc. You get the first insurance company like Prudential, New York Life, and Allianz, and others become easier, right? So the idea is, once you get the first domino to go, the first is the hardest, and we solve for that. We help with that. We try and get our startup founders access to the first reference customer, first flagship partner, which is more than worth its weight in gold today, especially because some of the other ways of hacking growth have are no longer true. So
Have gone
it's
away.
very
Yeah.
important today, even more so. It has always been, but very critical in today's environment, Michelle.
Yeah. Let me ask you one last question.
Yes.
Given the fact that let's say fintech is my main area of expertise and my main interest, and given your let's say wide experience in this market, I would like to understand which are the trends that you following the most in this market at the moment. We are coming from a very hard period in this market. So we're coming from 2 years of downturn, from 2 years of layoff and startups shutting down. Right now we are seeing a little bit of light at the end of the tunnel, in my opinion, a little bit of hope. So I would like to understand, where is, in your opinion, of course, the fintech market direct, and which are the main trends that you are following at the moment?
A lot of work happening in our world right now, Michelle, in what we call the enabling technologies, into the fintech ecosystem, right? So one big sort of focus we have is, how can you automate some of the various processes, and so as to reduce the cost of customer acquisition, which is the hardest, one of the hardest challenges when you are doing
Yeah.
anything in fintech, B2C fintech. You get killed on customer acquisition side,
Yeah.
right? So how do you solve for that? That is one area, and I think there is some new glimmers of hope where you can do a lot of these processes quite efficiently, if you can enable sort of these human augmented models on that front. So let's just take any brokerage or distribution business for financial products. There is a long process where you try and figure out who the right customer is, and then they reach out to you, you reach out to them, and then there's a lot of back and forth before they're onboarded as a customer. There are a lot of things you have to check on. There are a lot of things you have to take them through. Some of that can be done very efficiently through Gen AI based automation or bots that can simplify that process on your end. Not every step of that way has to be done by a human person, etc., etc. And those things can be amazing reduction and improvement in the conversion funnel. And so one big area is we are very focused on how can we reduce customer acquisition costs. One angle is this Gen AI automation. The other is embedded. Can you figure out seamless ways of getting embedded into others that already have a large customer base and create a win-win with them, so as to be able to, it could be embedded for lending, it could be embedded for insurance products, it could be embedded in, but distribution of embedded solutions seamlessly by being within somebody else's flow. Can that be done effectively and efficiently? It has been a theme that has always existed, but never executed very well. And I think there are lots of new ways people are going about that. So that's another theme. But globally, both of those leading to the same or solving for the same challenge, which is customer acquisition costs are very high in fintech. And how do you address those? And are there better ways of doing that? So that's one broad area. The other broad area is around automation, Michelle. There is a lot of opportunity. Fintech businesses in general have both incumbents and startups just have to go through a lot of processes. These are complex interactions and transactions, right? They're not one-off kind of situations. So to enable those processes at scale in an automated fashion at much lower cost but much better outcomes and quality is another sort of a theme that we are focused on right now in terms of automation. So enabling some of these things, customer acquisition cost, lowering the operation costs, and then making better decisions from an underwriting perspective. That's the third area that we are very focused on. So how do you do that? A key part of that is data. A key part of that is better models that then work on that data to create your outcomes. And to do so effectively, it's very hard today, right? How do you build these models, especially in a regulatorily compliant fashion, is an unsolved problem still. People do that very manually. So we are looking into that tech stack where things can be, models can quickly be monitored and can be built in a regulatory compliant fashion when it comes to lending, Fair Lending Act, and these various regulatory things that you have to solve for. And so there are different areas where the opportunity continues to exist. It's about looking at some of the new capabilities that are emerging with Gen AI and artificial intelligence, and how do you leverage and apply them in a new way. So that's sort of the way we are thinking about these things. But we could have like hours and hours of conversation on this.
Yeah, no, I totally agree with this one. I think that the main concept here is that we are looking not for the new technology here or for the latest innovation, but to actually make things more efficient under the cost point of view, under the processing point of view. So we are trying to make things smarter, not new again. And I totally agree about this one. Mostly, I would say in the open banking space. I think that we have been through a different kind of phases in that market, going from open banking to open finance to right now embedded finance. So I think that there's a transition that needed to be done, and I think that we will see the result and the outcome of that transition in the upcoming months and years, because I think that right now we are in the right way under that point of view. But yeah, it was very interesting, Ramneek. It was a pleasure to have you here, and I'm looking forward for your next investment. I will follow you closely.
Thank you, Michelle. Really appreciate it, and enjoyed the conversation quite a bit. Take care.
Thank you very much.
Bye.
It was a pleasure. Bye bye.
Take care. Bye.